Good afternoon. Thank you all for joining today's Emerging Manager platform call. My name is Kristen Steele, and I will be the call moderator today. These monthly calls are designed to support emerging managers as they're launching their first fund or expanding their strategy. And the goal is to provide a space for practical and candid advice from a team of experts who has been in your shoes before and has supported dozens of managers during their careers. So with that, I'd like to introduce the panelist. Eric Schultz is the CEO of Reliant Fund Services. We have Greg DaCosta, who's the Director of Accounting and Operations, and Jessica Deloria, who's an Accounting Director. So Eric, can you please start off with introductions?
Sure. Eric Schultz, I founded Reliant. I've been in the business for about 30 years, doing outsourced controller, outsourced CFO, taxes, as well as private equity, venture, fund admin, and basically have my whole career spent mostly working with emerging managers. And that's really where I like to focus, because I feel like my expertise on all aspects of the fund really can provide a roadmap for emerging managers. Greg?
Thanks, Eric. Greg DaCosta, Director of Accounting and Operations here at Reliant. I've been with Reliant for about 6 years now. Before that, I have about 25 total years of experience working at a lot of the larger fund admins and names you've heard, probably the State Streets, the SS&Cs, the Apexes. So I've seen a lot through my years. And like I said, we joined Eric about 6 years ago.
And then, hi everyone, I'm Jessica Deloria. I've been working in private equity fund administration for 18 years. I first started my career right out of college at a smaller fund called Palmieri Fund Administrators. In that same year, State Street Corporation acquired them. And altogether, I worked for PFA and State Street for over 6 years until I joined Broadscope Fund Administrators, which was founded by the same owner as PFA. I started at Broadscope as the 5th employee and ended up working there for 10 years, which included going through the Apex Group acquisition in 2019. And then now, almost 2 years to this day, in 2023, I joined Reliant, and I've really enjoyed being back in this small company atmosphere.
And we love having you, Jess.
Well, thank you all for your time today. Before we launch into the questions, I just want to mention a few housekeeping items. This call is intended to be interactive, so if you have any questions, please share them in the chat or click the hand symbol and we'll get to your question. If we aren't able to, because we're just limited to 30 minutes here, we'll just definitely follow up after the call with an answer. So now with that, let's get to the first question. So Eric, this one's for you. Introduce us to Reliant Fund Services and describe what sets you guys apart.
I would love to. So thanks, Kristen. So first off, I just wanted to set the stage. I hope you all excuse us if we seem a little rigid or nervous, as this is the first time we are doing something like this. Us as accountants are generally we like to stay behind the scenes. But we promise the next one's call, we will be a little more at ease. Also, again, before I tell you who Reliant is, I really wanted to say it's a pleasure for us to get a chance to reach out to so many emerging managers at one time. We feel that often emerging managers led down the wrong path of either being required to use a big name fund admin by one of their LPs or get drawn in by the latest technology that the fund admin is pushing. Just like every hire you make at the fund, we feel the most important thing in your fund administrator is the experience of the team of professionals that have been assigned to your work on your engagement. And so, thank you for being on this call. We look forward to talking a little more. At Reliant, our focus is simple. We help emerging managers with their fund administration and controller CFO needs, and I've been doing that for over 30 years. We have seen pretty much just about every challenge a new manager is going to run into. And our role is to help you navigate those challenges and put the infrastructure in place so that you can get the confidence to focus on raising capital and making investments. So why are we doing this emerging manager platform? We are not here to pitch Reliant. The reason we're doing it is simple. There isn't one place where emerging managers can go to get honest, real-world answers to the challenges they face. The ultimate goal is to build an emerging manager platform, which is a community where managers can ask tough questions, share their experiences with other managers, and get clarity on issues that matter most to them. But just as important, we wanted this place to be a place where general partners can connect with a team of trusted professionals who we have worked with and understand the realities of launching a first-time fund and are committing to helping managers succeed. We would love your feedback on what else we can cover in these calls that would make them more useful to yourselves.
Great. Thank you for that, Eric.
Sure.
So thank you to everyone who sent questions in advance. We're going to address those first. And then, as I said, if there's any additional questions that you have as we're going through the call, please just put them in the chat and we'll be happy to get to them. So this first question, Eric, I think probably you're best to answer this. So what are the key characteristics that lead to getting to a first close?
You know, as a fund administrator, we're not actually involved in helping with the first close, but as we've gotten more and more involved with handling DDQs from investors and outside vendors, you know, we really do see what makes some merger managers more successful than others. And getting to a first close really comes down to a few things. First, you really need a clear story. Why you, why now, and why this strategy? Following that, you really need a credible team with the right mix of experience and skills. You also need some early momentum, and you know, an anchor investor obviously is great, but even if you can get some strong soft commitments, it can go a long way in building investor confidence. And finally, you need to look ready to execute. You know, having your fund structure, your operation partners in place shows your investors that you're serious and you're prepared. Without that, there's really no reason for them to commit in the first close. You know, two other points I would like to emphasize. Making sure you set a realistic expectation on timing in this market. It is taking, the normal 6 to 12 is now pushed out to 24 months at best. In some cases, you know, at best. And also, don't overshoot your target. Don't overshoot your target size. LPs would rather see you hit a smaller first close than struggle to try to meet a larger close that takes a lot more months and bigger delays.
Thank you. All right, this next question is more technical. So Eric, I'm going to send this back to you. Can you explain the allocations of carry to executives, like deal by deal versus fund-wide allocations?
Sure, and I'm lucky to have the first two. So carry is usually structured in one of two ways, and the first is deal by deal, and what everyone usually calls an American waterfall. In that structure, the team can actually start taking carry as soon as one individual deal is realized, even if the fund itself is not in a carry position overall with its investments. It's motivating to the deal team, but the LPs kind of feel that they have a lot more risk if the later deals don't perform. And so, really the type of LPA that you're able to negotiate with your LPs will really decide whether it's an American or a European waterfall. The other one is a fund-wide, which is European. In this scenario, no carry is paid till all LPs are paid back 100% of their capital, plus a preferred return, which is usually 7 to 8% on the money from inception. It definitely takes longer for the team to see the carry, but it creates what the LPs think is a stronger alignment with the general partner.
Okay, thank you. Greg, this might be a good question for you. So what are the most common mistakes emerging managers make when structuring their first fund?
Thanks. So yeah, in our 25 or 30 plus years of working with first-time fund managers, we've seen a handful of mistakes that continuously come up. Avoiding these will save you time, credibility with investors. But I would say the first and most common mistake is really, like Eric mentioned before, which is underestimating the fundraising timeline. So most new funds managers, they typically expect to raise capital in about 6 to 12 months. But like Eric said, in today's environment, it really takes more like 12 to 24 months or maybe even longer. So just factoring that in is really important. And you need to really just plan for that extended runway of time to fundraise, because your expenses are going to be piling up in that time period, and you're really not bringing in any revenue or management fee revenue. So that's been a big one that we've seen from managers who've really, missed on that timeline of raising capital. Another common pitfall is, really overcomplicating the terms of your fund. Investors really just want clarity. They don't want like all these clever, unique structures. They tend to disengage if like they see like a confusing waterfall or fee structure that's complex. So, we always say just keep it simple on your first fund, crystal clear. It gives more confidence to investors. Another common one is really just like misaligning your investment strategy and the return hurdles. This is something Eric kind of touched on too. But really, you can destroy your carry if you like say you make early or pre-seed investments in venture. It's going to take many years for you to exit those deals. So, but if you promise investors, like Eric said, an 7 or an 8% preferred return, it's going to, the J curve is in there. It's going to kill you, and you're going to basically be boxed out of getting, carry for yourself. So that's even if your deals do well. So you just got to factor that in of promising a preferred return on deals that are going to not, come back until, 5, 6, 7, 8 years down the road. So just, lining up those return metrics properly is important. Another mistake we see is when general partners, really don't go for outside advice other than to their own legal counsel and their own legal team. So really that just kind of limits you to what your one legal team knows and the terms that they know and that they're comfortable with. But it's not really necessarily the most advantageous for you or your investors if you don't get additional outside advice. So sometimes like concepts like a management fee waiver would be something that is really appealing to investors, but it gets overlooked if your legal counsel isn't aware of that. And then I guess the final one is really just trying to do everything yourself. In the beginning, you want to save costs, so we see a lot of general partners that attempt to handle payroll, accounting, compliance, reporting, and they try to do so much on their plates. But the reality is that that's going to lead to like errors and distractions, because your focus as a general partner should be on raising capital and making deals. That's what you're good at. And then let the experienced people, handle everything else in the back and middle office. So that's a pretty common one as well. And I would say most of these mistakes that we talked about, that I went over, really come down to just, underestimating time, cost, complexity, or just not structuring your funds properly.
Thank you, Greg.
Of course.
And just everyone, just as a reminder, you're more than welcome to throw some curveballs at the team here. So feel free to provide your questions. We have a few more to go through, but if there's anything that comes to mind, please let us know. So with that, Jessica, this next question is for you. So what fund terms or structures resonate best with LPs when backing a first-time manager?
Yeah, thanks, Kristen. So as a first-time fund manager, you have to view your terms through the eyes of the LPs. They're taking on the additional risk backing a new fund, so they look for alignment, fairness, evidence that you are committed to working in their best interest. A few terms or topics that LPs are consistently looking at include management fees, GP commitment, carry structures, and the waterfall structure. For management fees, LPs like to see discipline, whether that's a 1.5% annual fee or a step-down structure instead of the industry standard 2% management fee. For GP commitment, LPs basically want to see the GPs committing anywhere between 1% to 5% of the fund. It shows that they have some type of skin in the game and that they're going to want to perform well. The key is to balance enough to demonstrate commitment, but not so much that it's raising concerns about potential overcommitment. And then for carry structures, a well thought out carry structure signals to the LPs that you're committed to working in their best interest. So there's two common approaches you can take. You can do a tiered carry or a reduced carry. In a tiered carry approach, as an example, you start with tier 1 at 20% of profits until LPs receive an 8% preferred return, then move to tier 2 and increase the threshold, showing LPs that you're incentivized to push for high performance. In a reduced carry approach, you can offer a lower percentage above a certain profit level, which LPs may view as a sign of fairness. And then for the waterfall structure, LPs usually prefer a European model, as Eric had described earlier, a full return of capital and preferred return before any carry is paid, because this just reduces the downside risk to the LPs. So basically the common thread in all these topics I just said is just showing humility, discipline, and long-term alignment to your investors.
Great. Yeah. Thank you, Jessica.
Sure.
So Eric, this next question is, I think, for you. Yeah, back to you. How can managers without a large institutional network build momentum with early investors?
It's really to start small and close to home. Friends, family, angels, founders, and trusted advisors are often the first believers in you. Even small checks can help you establish credibility in your fundraising. I think a lot of people have to point to whatever traction you do have, whether it's a clear deal pipeline, a relevant track record, or even a couple of early wins. LPs want to see evidence that you can find and execute on opportunities. A major one, which is often just not considered as important or relevant, is your deck and messaging. Need to answer that one question that everyone is going to ask. Why should I trust you with my money instead of someone else? If your materials don't make that case, it's going to be very hard to build momentum going forward. A lot of managers also try to start off by launching SPVs or co-investment vehicles to build a track record before raising a larger fund. That can make your eventual fundraising far more compelling.
Great. Thank you for that. And Greg, following up on that question, when should managers begin thinking about Fund 2 and what do LPs want to see?
Yep, that's a good question. I mean, I know we're here talking about, emerging managers, and you guys are thinking a lot about Fund 1, but it's never too early to start thinking about Fund 2. Even if Fund 2 feels like it's such a long way off, it's really important to start planning early, because the path you set for Fund 1 will really directly influence how investors see how you're doing for Fund 2. So I guess in terms of timing, it really varies manager by manager. Fund 2s typically launch about 3 years after Fund 1's final close. That's kind of like a good benchmark, because by that point, most fund managers will have deployed about 60 to 75% of the Fund 1 commitments, which really only leaves you, enough for maybe one more deal, some, follow-on deals, and some fund expenses at that point. And then, so, I guess the question, like you said, what do investors really look for in a Fund 2, right? So, even if you haven't fully exited, don't have any exits yet in Fund 1, because let's just say it's only 3 years in, investors just want to see clear progress, discipline. So some examples of that are, obviously, the biggest one is, how are your deals doing in Fund 1, right? How are they performing? What are they doing? And that's the biggest and the biggest and most important one. They also look to see how you structured Fund 1 deals, like to see if they were well structured. They have good reserves that they can you can put on. Another important one is, obviously, another big one is if Fund 1 investors are re-upping into Fund 2, because that's the strongest signal that Fund 1 investors have confidence in you to reinvest their money in Fund 2. They also want to see professional, transparent, reporting practices to investors. And they want to see a management team on the GP side that really has grown strategically over the last couple of years and is ready to handle a second fund that's in typically a larger fund. Just remember, I guess, keep in mind that Fund 2 success, like I said, is built during Fund 1. Investors want to see a positive momentum, discipline, and just that signals that you're not just raising one fund, but really a firm that will be there for them for the long term.
Great advice. Thank you. So we're going to switch gears here a little bit and talk about the management company. So Eric, how should managers budget for fund operations in their first raise?
Sure. So, too many first-time managers underestimate what it really costs to run a fund. The manager fee has to cover not only the operations, but all the salaries and raises and bonuses and things along those lines. And because your fee is generally fixed for the first 5 years, you really need to build a 5-year cash flow budget that gives the company stability to run through until Fund 2 is up and running. On the fund side, that means budgeting for organization, fund admin, audit, tax, legal, compliance, technology, etc. The LPs expect professionalism, and they notice quickly when your operations are underfunded. A solid budget shows the LPs that you understand the business of running a fund and not just making investments. If it's helpful, I'm happy to share a sample core operating budget. We have one for the fund and one for the manager company with anyone on the call who wants a practical starting point.
Yeah, and if you'd like Eric to send that, just put your email in the chat here, and we'll be happy to send that after the call. All right, I think we're running short on time, so just one last question here. So when is the right time to bring on a CFO and a fund administrator?
You know, it's a great question. Sorry, Chris. It's a great question because something I deal with a lot with my emerging managers. You know, the timing is critical, specifically to bring in a fund admin early on, because that's what the LPs start evaluating, which is that you have a fund admin in place before the first close. They really, if you think about the fund admin handles all the investor onboarding, the capital calls, the reporting from day one, and having them set up early signals professionalism and instead of having to scramble later on. If, for example, if you have to do a capital call without a fund admin. As for a CFO, most managers don't need to hire a full-time CFO. I happen to think they don't need one for the first 5 years because there's just not enough work for a full-time controller or CFO. And that's why an outsourced CFO controller can really be valuable. They help with budgeting, financial modeling, accounting oversight, and can prepare you for investor due diligence. And the best part is it's usually around a third of the cost of hiring a full in-house staff. You also don't have the overhead of carry giving to the CFO, as well as you're only getting the knowledge of that one CFO rather than a team that has been doing this for multiple funds. You know, there is a belief out there that having the same firm provides both fund admin and outsourced CFO isn't a good idea. And I understand why people say that, but I think they're worrying for the wrong reasons. Basically, the main point is that they're worried about independence. And, you know, independence obviously is very important, but the reality is when it's done right, it actually makes your back office stronger. You know, the fund administrator is handling everything for the fund, reporting, reconciliations, investor services. And the outsourced CFO is focused on the management company, managing cash, budgeting, forecasting, and actually reviewing the work of the fund admin, which without that person, generally speaking, it's left to one of the partners to do that work. So, you know, those are definitely different functions, and having them under one roof means fewer gaps and clear communication between teams. What really matters most is that you have the proper checks and balances in place, and not that you split up the fund admin and the controller because you have to do it just for optics.
Great. Well, thank you all for your time. Before we wrap it up, is the three of you, do you have anything else you'd like to add?
You know, I said it in the beginning, and we're not really here to pitch Reliant, but we feel that a lot of our competitors are taking on emerging managers because they have the name, and it really does matter the team you pick and the ability for the team to stay there rather than constantly leaving and having a new team come in place. So that is going to be one of the most important hires you guys make, and therefore you should really focus on the team you're going to get as the most important priority.
Well, thank you to our panelists as well as everyone who joined today's call. We will be following up with a recording of the call and the panelists' contact information should you want to reach out to them with any questions. And for those who requested a copy of the budget, we'll also follow up with that. We will be hosting our next call at the end of October, and we'll be inviting one of our platform partners to join the call. So more to come on that. So just be on the lookout for that information over the next couple of weeks. And again, thanks for joining, and we hope you have a great afternoon.
Thanks everyone. Thanks, Kristen.
Thanks, guys.
Thanks.
Bye, everyone.